All right, so today we get to talk about monetary policy. So we already spoke about fiscal policy, which is half of the policy that we talk about. And especially for this course, then monetary policy is going to be super important. So whereas fiscal policy is done by Congress, or it's done by the government, monetary policy, on the other hand, is handled by this thing called the Federal Reserve. The Fed, as we'll call it, is our country's central bank. And through this monetary policy here, they control the money supply, what interest rates look like, so on and so forth. And they're kind of an interesting body. They're like half private, half public, meaning they're like half government owned, half privately owned. So they're not part of the government, but at the same time they kind of operate like they are. So it's a thing. But for the most part, they're supposed to be an independent body, like not respected to politics, anything like that. Um, so again, here's something more official here. Here's a really important term for all of this. It's a central bank, really, is that does this thing called monetary policy. For us, it's going to be the Fed or the Federal Reserve. Other countries have different things, like the Bank of Japan, Bank of England, whatever it is. And their goals here then are kind of similar with our fiscal policy, is to promote full employment, to maintain price stability, and to encourage long-run economic growth. There should be a growth on there somewhere, but there isn't. So those are the big things. Now, especially with the Fed and then having control over interest rates, the big thing with them is price stability and kind of the encouragement of long-run growth. But price stability to be sure, because when we're talking about price stability, what that means is that inflation isn't getting out of check, and that's what they have more direct control over. Um, and then past that, what they have a little bit of control over is long-run economic growth through their interest rates, and then employment's the kind of hairy one where that's more so fiscal policy than monetary. So what we're going to see then is that the difference between monetary policy and fiscal policy is that in a lot of ways, a fiscal policy is like the gas on a car. Again, when we're talking about fiscal policy, we always want to use expansionary policy, right? People want lower taxes and they want more government spending. They're very, very popular things. Um, that said, though, what monetary policy ends up being is kind of the brakes, all right? Um, they're the ones who do get to do contractionary policy and not really get a super big negative backlash. Um, in part, it's because people don't really understand it, and also because it's a lot more quiet, I guess you could say. So there's going to be two different kinds of monetary policy broken down into three different kinds that we'll get to here in a second. So we already talked about these terms here, expansionary and contractionary, or in this case, it would sometimes be called easy or tight money. So expansionary is when they're trying to make aggregate demand go up, and contractionary is when they're trying to make it go down. So that said, expansionary is to counteract the effects of recession, get us back to full employment, whereas contractionary is to counteract an inflationary gap and get us back to full employment. So again, just like fiscal policy, it's responding to the same things. It's just, again, usually it'll be fiscal policy that fixes recessionary gaps, and usually it'll be monetary policy that fixes inflationary gaps. Which isn't to say that they can't fix the other, it's just that, well, it depends on how popular these decisions are. Now, here's where we get to the actual tools and the different kinds of tools of monetary policy. So these three right here are the ones we need to know. There's an extra one here that'll pop up here in a second, but just these three. So it'll be the required reserve ratio, the discount rate, and open market operations. Sometimes when we write out open market operations, we'll just write out OMO. All right, so get used to seeing this thing. And then we're going to go all into all these here in a second. Now, there's another new one, which isn't really so much part of the curriculum. It's just kind of a throw-in for, see what's going on with the Fed and all that in reality. So, first one, the required reserve ratio. So with this, banks, what they do is that for all the money that's deposited in them, they have to keep so much of it on hand. All right, so much of the money that they have, they need to physically have in a bank vault. All right, or deposited in them electronically, however you want to say it. They need to have so much money from their customers legally, and that's what the required reserve ratio is. So if there's compared to their loans and things like that. So the reserve ratio then in reality is usually pretty low, near zero in a lot of cases. It's the least used tool of all of these, just because banks realistically, they're usually nowhere near what the reserve ratio would be anyway, with 0 or even 10% of the money being required for this. So it's not really something that ends up being super impactful. Now, if they did decide to raise the rate super duper high, right, like 70%, which is very unlikely, then yes, it would be very impactful, but it doesn't really so much happen. So that said, let me just double check all this, make sure we hit all the big parts here. Reserve. We'll get all this visualized here in a second too. Don't worry about that. So anyways, the big idea is that if the reserve ratio is low, that means banks need to hold less money, and if the reserve ratio is high, then banks need to hold more money. And again, we'll get to some specific stuff for this here in a second. Contractual clearing balance. This I wouldn't worry about this at all. It's just pretty much saying that banks that aren't subjected to the required reserve ratios, they have that instead, where they need to prove so much of stuff like that. Now, discount rate. What this is it's going to be the interest that banks pay to the Fed for loans, because the Federal Reserve in a lot of ways serves as a bank for banks. So decreasing the discount rate then lowers the cost of borrowing for banks. And as the discount rate goes down, that means the money supply will go up. As the discount rate goes up, that means the money supply will go down. It's how much money it's going to impact the willingness of banks to borrow from the Fed. And in a lot of ways, the Fed is kind of their last resort. Because there's another important thing that the Fed kind of determines, called the federal funds rate, which isn't officially a tool that the Fed uses, even though it's called the federal funds rate. But it kind of ends up being what determines all of this. And it's kind of driven by what the discount rate is. So it's going to be the second most used of these, mainly because, again, the idea is that the Fed is going to charge them pretty high interest rates compared to other banks. So again, it's kind of their last resort. A bank would much rather borrow from another bank than borrow from the Fed, because the other bank won't charge them as much money. And that's what it boils down to. Another question you might have is, why would banks want to do this to begin with? So going back to our reserve ratios, what might happen is say a bank wants to give out a big, huge new loan to somebody, but they don't have the required reserves for it. One way to get around that is to borrow money. So once they get audited by the Fed, they're like, "Yep, we got all the money we need. Here you go," and then they end up paying back that loan almost immediately. So they can have out that big, fancy new loan. And I think, yeah, it even says that in here. So they meet the required reserve requirement with that. And what we end up seeing then is that, again, low rates is expansionary, high rates is contractionary. Because, as the rate's higher, that's essentially the interest. That's the interest that they're paying. So they want to pay low interest. They don't want to pay high interest. And then we get to our most important one. Oh, here we go. So it does mention the Fed funds rate. So like I said, it's going to be higher than the federal funds rate. And that says Fed funds rate right there where I'm blocking it off. And again, what the federal funds rate is it's going to be the rate that banks charge one another for loans, which is targeted by the Fed, but isn't necessarily officially controlled by the Fed. It's kind of controlled by the Fed because of the discount rate. Like, the federal funds rate will never be higher than the discount rate. But still, they can't just say that it's this and make banks charge each other so much for loans. It doesn't work that way. Now, open market operations, this is going to be our most important one. So when we're talking about those bonds or securities or bills or whatever it is that we'd mentioned before, this is the purchase and sale of said securities. So let's see here. There we go. Oh, like I said, primary tool of monetary policy, most important one by far and away. So in some ways, it ends up impacting excess reserves. In other ways, not so much, because the idea is that some of them are very long, and you get guaranteed interest rates, and banks will very often, and by very often I mean almost always, they will hold their own bonds, just as well as you and I could. But banks are going to be one of the biggest purchasers of them. And with that guaranteed interest rate from the Fed, it's kind of like an alternative, I guess you could say, to loaning out money. And the idea with it is if the Fed sells a bond to a bank, that's money that the Fed now has and the bank doesn't have, right? And since the bank doesn't have the money, that means they can't put out new loans. And that's where we start seeing a lot of the big stuff with this. So there's something you might have heard in the news called like quantitative easing. It gets thrown around a lot. And essentially what quantitative easing is it's all backed by open market operations. It's like as the Fed wants to lower or increase interest rates, they'll act accordingly with the open market operations. So for example, if they want less money out there, that's when they sell bonds, right? Because the Fed's giving their piece of paper to banks, people, whoever it is, or if they want to inject more money, that's when they start buying bonds. And as they start buying bonds, that's the Fed giving their money for people's pieces of paper, so on and so forth. With that, so there we go. Like it's mentions in here, excess reserves really is what it all comes down to. As the Fed is selling these bonds, there's less excess reserves that banks will have. As they're buying them, there's more. And as banks have these excess reserves, they're going to be more likely to give out loans. For example, with our current state of the economy, interest rates are very, very low. They're incredibly low because banks have all of this money that they want to loan out, but there's not very many people to actually borrow the loans. I was talking to one of my friends just this weekend. He got a 1.99% interest rate on a 30-year mortgage. That is absolutely insane. So, yeah, pretty low. And then this one, we're not really going to worry about this at all. Essentially, it's kind of discount ratey type stuff, but it's short-term loans again by banks from the Fed. But this isn't officially in the curriculum, so nothing to worry about. Now back to why banks need these overnight loans through the discount rate, federal funds rate. And again, a lot of what it is just to get around the required reserve ratio, which is very low. It is. It's like near zero even. So what we'll see with this is just that, and it's a big idea of this, is that in order for banks to be able to make out new loans, they need to have so much money on hand. And if they don't have so much money on hand, then they're in violation of the Fed. And in order to avoid being in violation with the Fed, they have to, borrow money to get there. So they'll pay little interest on it because they'll pay it back very quickly. And they'll still get to put out all the new loans that they want. Here we go. This is what I've been looking for. So this is going to start visualizing all of this for you guys here. So this is going to be expansionary, right? And again, we implement an expansionary policy to counteract a recession. And then this net exports part, don't worry about that just yet. That's something we'll worry about later on. So for expansionary, when we're looking at these different things, we're only going to focus on these first three. We're not going to worry about the fourth one. So the reserve ratio will go down. That means that banks need to hold less money. Discount rate will go down. That's less. That's lower interest rates from the Fed for banks to borrow money from them, or they can buy bonds. Now what this looks like is that excess reserves will go up, making the money supply go up. All right. Again, it's the Fed who's in control of the supply of money, which will cause interest rates to go down, which makes investment go up. And that's what this is all about. Is that investment, again, it's very directly tied to interest rates, right? As there's lower interest rates, there's more investment. So as investment goes up, aggregate demand will shift to the right, which makes price level go up and GDP go up and unemployment go down. So again, as we're shifting this along, hopefully that's not going to get this on a graph for us, which is unfortunate, but I'm pretty sure it will here shortly. And now, because interest rates are down, now we have the demand and supply of money. All right, so demand is either going to shift to the left or supply is going to shift to the right. Now that's one of the hairy ones. That's something we'll talk more about next unit, but just rest assured that is what happens. Which anyways causes the value of the dollar go down, makes U.S. goods cheaper, foreign goods more expensive. And this is again, this is foreign exchange, so I don't need to worry about it too much just yet. But it's good to start thinking about it. But it makes our exports go up. So this is one of the kind of good consequences of the value of your dollar going down is that you get to sell more stuff to other countries. You also get to buy less stuff from other countries. So it's what it is. And it makes our imports go down. So net exports go up, and aggregate demand increase is going to further end up increasing. So pretty wild stuff there. Now here's what all of this is gonna look like. So the only two that matter here are going to be these two right here. This is the investment graph, which we don't really need to worry about in here. This is the money market. We're going to talk about that more in our next video, I assure you. So don't worry about it too much just yet. And then this over here, of course, is our aggregate model. So with this, that'll be an increase in the money supply with expansionary monetary policy, which again, like we just talked about, will be an increase in aggregate demand, making unemployment go down as GDP goes up and making inflation go up as well as price level goes up. So, and then contractionary here. So with contractionary monetary policy, that means they're trying to rein the economy back in, and this is usually what monetary policy is going to end up being. They're going to want the reserve ratio then to go up, meaning banks need to have more money on hand. All right, they need to hold more money. They can give out less loans. Discount rate will go up. The discount rate will go up, meaning that the interest that the Fed charges on their short-term loans to banks is higher. Or they can sell bonds, again, meaning that the Fed is taking a piece of paper saying, here's some money in the future, give me your money now. And they get the money out now and kind of push the problem off till later. So what that's going to look like then, excess reserves will go down because banks are now required to hold more, is really what it all comes back to. And with that, the money supply will go down. As the money supply goes down, interest goes up, which leads to a decrease in investment, meaning that our aggregate demand is going to shift to the left. And as it shifts to the left, of course, that means it's a decrease in aggregate demand, making price level go down and GDP go down, and unemployment goes up. Now, that said, this is where we start making our connections across the curriculum here. Because interest is going up, then the demand for our dollar is going to increase and the supply for our dollar is going to decrease. And again, this is something we'll explain more later on, which makes the value of our dollar go up. Our goods are more expensive. And again, so our dollar ends up being stronger, but we are more expensive, so people buy less from us. And foreign goods are relatively cheaper, though, which helps us have a good quality of life because we can buy more stuff more cheaply from other countries. What this means, though, is that it in turn ends up making our GDP go down even more because we're selling less to other countries and we're buying more, giving us this massive negative portion of GDP, which is where we're at, and we have been at for a long time because our dollar is so strong. Anyways, our imports go up, net exports go down, and there we have it. So that's all I got for you today. Big things here especially are going to be those three different things, those three different tools of monetary policy, the way that it's impacting the economy, so on and so forth. Let me know if you have any questions.